It's tax season, and to talk about what to do with that tax money that you're going to be getting back, we're joined by Laura Southall. And so, first of all, let's clear up that if you get money back from the government, it is not a gift from the government. It is your tax money that you have paid over the year, and they have decided that they took too much away from you, so now they're giving some of it back. Is that kind of what a tax refund is?
That's right. That's exactly right. And so don't think of it as a gift from the government, for sure. That's your money, and they're giving it back to you. There's lots of different things that you can do with that refund to benefit you more. So first thing you want to do, and every situation is different, but these are good suggestions. First thing is, if you're carrying any credit card debt or line of credit debt, that's a good thing to do. Use that refund to pay down that debt. Another option is to take that money and contribute it to your RRSP. Because if you contribute it to your RRSP, then you're going to get another refund next year. So the refund that you get from the RRSP is based on your tax bracket. So if you're in a 40% tax bracket and you put $1,000 into your RRSP, you're going to get $400 extra back the following year at tax time, which is great. So you're taking your refund, putting it in your RRSP, and then getting another refund. Another option is the TFSA. So you can put that money in a TFSA.
And that stands for?
Oh, sorry, tax-free savings account.
Because if I just cut you off for a minute, so the money you get back is already, the tax has already been paid on it. So it's not like
That's right.
So the TFSA would really be more so than the RRSP, I would think. No?
No. So the tax-free savings account, think of them both as a box. So you put your money inside the box, and they both have different rules. If you put your money into the RRSP, then you are getting money back because you put money into that box. So if you take your $1,000 tax refund that you get at tax time and you put it into the RRSP box, and you're in a 40% tax bracket, you're going to get 40% back when you file your taxes for 2022. But with the TFSA, tax-free savings account, you put your money in the box, no refund. But what happens is when the money grows inside of that tax-free savings account, you can take the money out and you don't pay any tax. With the RRSP, when you eventually take your money out of it, you have to pay tax. That's the end result. So both are boxes. At the beginning of the RRSP, you're going to get money back from contributing, not with the TFSA. But in the end, when you go to take money out of your box, tax-free savings account comes out free and clear, no tax at all. With the RRSP, you pay income tax on that withdrawal. So for lots of people, they're in retirement, they don't have a high tax bracket, and it's easy to take money out of their RRSP and they won't pay a lot of tax. But for some people who have a high pension, they take money out of their RRSP and they have to pay 30-35% tax on it, and it's painful and they hate doing it. So the tax-free savings account, it's way more, gives you way more freedom. You don't have to wait until you're in a low tax bracket. If you want to go to Australia next year, you can take money out and there's no tax at all, no even considerations of the tax implications.
And just go ahead.
Yeah.
Just to point out too, at a certain point in your life, that an RRSP ceases to be, and it gets put into a RIF, RIF, and then you have to take out, whether you want to or not, they are going to send you money every year, and that is taxable.
The thing to think about, so the RSP at age 71, you need to convert it to the RIF. And what the RIF means, and some people are confused on this, it means that now you are forced to take a little bit out every year. So you don't have to deplete your whole RRSP in your 71st year, just a little bit at a time. But still, it can be painful tax-wise. Some people take the money out of their RIF and then they put it in their TFSA so that they're never paying tax on it again. but still you have to pay the income tax coming out of the RIF. The other thing to understand about the RRSP or RIF is when you pass away, if you have a spouse, your RRSP or your RIF can go tax-free to your spouse, which is great. But if you don't have a spouse and you pass away, it's as if you withdrew everything from your RRSP on the day of your death. So sometimes you're paying 54% tax on what's in that RRSP. If you have $250,000 in your RRSP and you die, that's going to be taxed at 54%. It's as if you withdrew everything. So sometimes people want to not withdraw from their RRSP because they want to avoid paying tax. But if you don't withdraw and then you pass away, then you've got a massive amount in your RRSP too. So you're paying tax.
Got it.
Either way.
Either way. So if you withdraw from the tax, so then you're paying the tax, but you're paying it at a lower rate. So better to take some money out. And even if you take the money out, pay the tax, and then put it in a Tfsa or even just a savings account, just something, just sock it away somewhere. And that way it will easier on the people you leave behind, for example, you know, your kids, the charity you're leaving money to, because they won't have the big tax bite at the end of it. Got it.
Which is what the government is sort of trying to force you to do by starting you in the RIF at age 71. But that doesn't mean people like paying that tax. It's not very fun for them. But it is good that it gradually decreases it instead of you could leave all your money in there and then pay tax.
Right. Now,
so if you were getting $1,000 refund, I would say pay down debt, first choice. Contribute to your RSP if it makes sense for your situation so that you get the tax refund. Contribute to a TFSA, great idea. It's always a good idea to contribute to your TFSA because there's so much flexibility and no tax. And then the other thing you could do is pay down your mortgage. Always a good thing to pay down your mortgage.
Right. Get out of debt, especially credit card debt, running at 18 or 22% or something. Like, come on, get out of that. That is definitely the first choice. If you're choosing and you have credit card debt, I would choose that first. That is a lot of money. That's going out. So some people just stay under the radar. They they have not filed a tax return in years, but there's a downside to that too. You know, at some point, like when you go to collect your CPP, for example, they may not even know.
Yes.
Right. Yes.
No, you don't want to do that. That's a recipe for disaster. File your taxes.
I know people that, and some of them are rather proud of that, and I think I don't quite get it, but it's like come clean. Well, okay, so what happens if someone says, okay, you convinced me, I'm going to come clean. I haven't done a tax return in 5 years. What do they do? What do they do about that?
Well, first of all, I'd probably hire an accountant. I wouldn't want to go back 5 years by myself. But I would also, you want to call CRA or Revenue Canada and talk to them and say, okay, I haven't filed in 5 years. I'm going to work on this. Give me 6 months and I'll get these 2 years done, and give me 6 months and I'll get another 2 years done. Because they start to get really angry when you don't file your taxes. And the punishments are harsh, and sometimes they'll even seize your bank account. So you don't want to put yourself in that situation at all. And you're right. I mean, at some point you're going to want to collect CPP, which is Canada Pension Plan, OAS, Old Age Security, and if you haven't filed your taxes, you're not going to get those. And so many seniors in Canada count on those for their retirement income.
It's really nice. Just for being you at 65, they start sending you checks. It's wonderful. It's like, wow, I didn't have to do anything for this. This is great.
So just so the viewers understand, CPP and OAS are two different things. CPP is based on how much you worked and how much you contributed to the Canada Pension Plan. So everybody's number is different. The average Canadian is getting about $700 a month from CPP. if they wait till 65 to take it. They can take it as early as 60, but then it's reduced. But
Okay.
everybody who's lived in Canada for 10 years is entitled to OAS, old age security, at age 65. And this quarter, I think OAS is at $635 a month. And that's everybody, unless your retirement income is over 79,000, and then it starts to get clawed back.
Right.
Once you hit 120,000, then it is clawed back completely.
Well,
so when people refer to the OAS clawback, that's what they're talking about.
but then there's the other side of it, that if you're not well-heeled and and your income is that much in retirement, and you're the other side of it, there's a supplement. So
Yes,
they will make
guaranteed income supplement. That's right.
And so it saved a lot of seniors from living out their lives in poverty, and it's a really great thing. So, oh dear, well, a lot of information there. Thank you so much for thanks so much for sharing it with us.
Oh, you're welcome. Anytime.
Thank you.